Good morning and welcome this morning to Long Verticals and Diagonals, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab, and I'm joined out there in the chat today by my good friend Michael Fairborn, another phenomenal educator, 20-plus year veteran of the financial markets. He's there to help answer your questions specific to this discussion today. And speaking of that, we're going to talk a little bit about long verticals. We're going to manage some of the long verticals that we've looked at previously. Some things are maybe starting to fly when it comes to the airlines. We'll take a look at that specifically as an area of focus as we examine some long vertical spreads. So let's jump into this discussion. A couple of quick housekeeping items that we need to take care of really quickly here. Remember that everything we talk about is simply for illustrative and educational purposes only. It is not a recommendation or any kind of an endorsement. Remember that options carry a high level of risk. They're not suitable for all investors. Make sure that you understand the characteristics and risks of standardized options before considering any option transaction. Remember also the multiple leg option strategies like vertical spreads, like diagonal spreads will involve multiple commissions. Spread trading must be done in a margin account. Remember, anytime you are short an option, there is the potential for that option to be assigned early. Now, we're going to be using the thinkorswim desktop software platform, specifically the paper money version of that. That's not a guarantee of future success out there in the real world. It's a great learning environment. But one of the things that it does not do as opposed to a live trading account is that the paper money account does not facilitate that early assignment of short options. So be aware of that, especially as you get into the context of practicing long vertical spreads, long diagonal spreads. Anytime you have a short option component to that, make sure that you're aware that the paper money platform is going to behave differently. Remember that investing involves risk, including the loss of principal. Again, one of the things to keep in mind is that there are a lot of different ways to look at the market. Technical analysis, probability analysis, fundamental analysis. None of them are guarantees as to what's going to happen. They are all theoretical in nature, and as such, Schwab doesn't recommend the use of technical analysis as a sole means of market research. Remember also, of course, the past performance of any security or strategy doesn't guarantee future results or success. So let's jump into this discussion here really quickly by reminding everyone that coming up, we're going to be in Anaheim next week from tomorrow, with one of our market drive events. Great top-down discussion. It's going to be myself. It's going to be Joe Mazzola. It's going to be Mike Townsend, Kevin Hinks, Tom White. Barb Armstrong's going to be there. Kevin Horner is going to be there. It's going to be a great opportunity to join us if you're on the West Coast and learn a lot. Then we're going to the East Coast, Miami. We're going to be doing a 2-day workshop, technical analysis and options strategies at the end of September. And then coming up in October, we're going to be in Santa Clara doing another market drive event. And then we're going to be coming at you in Denver with the 2-day workshop. We got a lot of stuff going on. All of those events are up and ready to be registered for at schwab.com/events. So join us for one of those if it comes to an area near you. Those are at no cost to you. So we hope to see you at one of those events. Now, here's where we're going to go today. We're going to talk primarily long verticals today, but we're going to manage some of the positions that we have currently in our example portfolio. We're going to talk about the impact of price, time, and volatility. Volatility maybe being one of the primary considerations at this particular point, given the uncertainty that's going on in the market. And then we're going to look at some example illustrative trades to help us to understand these ideas. So I'm going to do this. I'm going to switch over to the thinkorswim platform. And remember, this is the paper money version of the platform. So it is, again, a great learning environment, not a guarantee. But it is also a good reminder for me to ask you to do one thing for us. And that is to click on that subscribe button down at the bottom of the page if you have not done so already. So I appreciate you doing that. It's going to make sure that you can set up alerts so that you can see new content and archived content and it's at no cost to you. So give us a quick subscription there. Click on the like button if you like what you see. That helps to pop the content up to the top of the feed as well. So taking a look at what's going on in the S&P 500 today, this is kind of setting us up for this discussion. And I talked a little bit about this yesterday in the Protective Strategies webcast. Talked about it this morning in the Futures webcast. Just kind of sitting here spinning at this sideways support level, the horizontal support at the confluence of the 50-period moving average at this particular point. We see these double kind of inverted hammer candles, if you will. There's one and there's two, and really just kind of sitting there doing a whole lot of nothing at the moment. RSI kind of finding a bit of stasis, not really pushing lower. Moving averages just kind of staying where they are. Perhaps this is a bit of a wait and see until we get non-farm payrolls tomorrow, right? That's perhaps the next big market moving influence. The ADP numbers today were a bit softer than expectation. But again, those can be revised, and as can the non-farm payrolls. All of these numbers get revised to a certain extent. So it's going to be an interesting scenario. Taking a look at the NASDAQ. The NASDAQ was starting to move a little bit earlier, maybe trying to make a little bit of a bounce. It seems to be backing off a bit. RSI relatively flat here on the NASDAQ. And the Russell 2000, neither dropping nor rising at this point, just kind of giving us some more equilibrium right at the 50-period simple moving average in this particular case. So that being the case, we're kind of at a standstill. So the question then is, in using vertical spreads, specifically long vertical spreads that are generally directional expectations, how do we do that? Or why would we do that, right? Why would we look for a long vertical spread in a scenario like this where there isn't a lot of movement? Maybe the movement isn't in a direction that we expect it to go. And so one of the things to think about, I'm going to change my grid over to our VIX grid here really quickly. We're taking a look at volatility. So volatility today is kind of pulled back, giving us maybe a little bit of this bull flag type of pattern. But there certainly is the potential for a rise in volatility if those data points come in at some sort of unexpected characteristic, right? So a 2-day pullback here in the VIX back down to the 50-period, or the 30-period in this case, moving average. You see the VIX rising a little bit. We take a look at what's going on with the market as a whole. Market kind of going to stasis. VIX kind of sitting right there where it is. So volatility backing off just a little bit, but not a lot. I mean, certainly not bleeding back down into that 14 or 15 handle like we were 3 or 4 days ago, right? And we take a look at the VIX versus the VVIX. The white line is the volatility of volatility. The blue line is the VIX. So this is the relationship of volatility to the volatility of volatility, if that makes sense, right? And volatility of volatility is still relatively high, right? We've talked a little bit before about when volatility of volatility is low, that can be an indication of the possibility of a rise in volatility because maybe the market has become a little bit less expectant of news. But now volatility is still staying relatively high, so we kind of have this expectation that volatility is likely to continue to move higher here. The market has that expectation of higher volatility. All right, so that begs the question, going back to this perspective of the market kind of sitting at this level with the possibility of a bounce. What do we do, right? Do we look for directional trades? I think the answer is probably, a qualified yes, in the sense that the trend is still moving higher and we're finding a level of support. But maybe we look for vertical spreads, directionally sensitive trades that are also sensitive to changes in implied volatility. So we'll see what that looks like here in just a minute. So what I want to do then first, before we get into that, is I want to pop over here to the monitor tab, and I want to take a look at a couple of the positions that we have on currently. These are illustrative examples, again, not recommendations by any means, but we have a couple of them on here that present some opportunities to do something, right? So we've got this long put vertical on Coca-Cola, right? And I'm going to go to the charts once again, and we'll put this on the single grid, and we'll take a look at KO. And the expectation was that Coca-Cola was going to move to the downside, right? Yeah, and Ranjit, yeah, absolutely. I think that is not necessarily a bull flag or a bear flag, but the potential for a bull flag here in that possibility, and that the directional movement is still to the upside. So maybe a little bit of a bull flag here in Coca-Cola, but we had, in putting this trade on, looked for a directional down move, right? Sold the 66 put, bought the 64. The expectation was that the price of the stock was going to continue to move in the opposite direction. And it's kind of stayed right about there where we expected it to move. So we might look at taking this position off entirely in this particular case, simply given the fact that we're now down to 8 days to go until expiration. So closing the trade down, right click and clicking on confirm and send, reading through the order, making sure that we're aware of the order and the characteristics, and we'll send that order off and see if we can close that trade down. And we actually closed it down for a little bit of a loss here in this particular case, but we're close to that expectation. Price of the stock hadn't done quite what we had expected it to do. Now, the other one that I wanted to look at here really quickly was a long call diagonal that we have on ABBV. Okay, let's look at the chart here for ABBV. And our expectation was a continued move to the upside, right? We had even looked at this in the context of a bull flag, but we've got this rally up and this little bit of a pullback, and maybe just breaking that support level at the moment. That doesn't really bode well necessarily for this long call diagonal. The expectation was that the price of the stock was going to continue to move higher. So we bought the long call out to the November expiration. In this particular case, 71 days to go until expiration. Bought it for $6.15. Currently trading for $16.90. And then we sold the 195 call against that. The expectation being that in order for this trade to get to theoretical maximum gain, the price of the stock at expiration, which is 1 day from now, ought to be somewhere up there around 195. And it is currently down around 193. So 195 is where we are short that call option. That's right about here. All right. So we didn't need much movement, but it's not quite there yet. In fact, we're starting to see this move to the downside a little bit. Okay. So that might that might put us in the context now. Let's look at the monitor tab of saying, look, we could keep this long 180 call, right? And it's gained a little bit of value here over time. Our short call has lost value, which is ideally what we want to see happen. But we're in danger in this case, if this continues to break that support level, of losing any of that intrinsic value that we may have here in this long call option, right? You know, the other side of that coin is, and this kind of gets me to my point. Let's go back to that chart, and I'm going to put on this chart an indicator, IMP, implied volatility. And I'm going to click on apply. Notice what's happening to implied volatility is the price of the stock starts to pull back a little bit. Implied volatility is rising just a little bit. So if implied volatility is rising, that's likely a result of overall volatility rising and the price of the stock going down. Now, at the end of the day, which is a bigger driver? Well, this kind of gets us to the central focus of this question. By the way, speaking of central focus, there is a feedback survey right there in the chat. If you guys wouldn't mind filling that out for me, that is really all I ask of you in this discussion today, is to fill out that feedback survey. Let us know what you think. Again, remember, our focus is on making these webcasts better. So we want to be able to do that for you. Do me a favor, click on that link, open up the page that opens, set it aside so you can come back to it after the fact, and then refill, and then we'll come back and focus on the webcast. But then you can come back and fill that survey out after the fact, after we've gone through all of the discussion. I appreciate that. Thank you. And Mike's going to pin that at the top of the chat so that you can get to it easily if you happen to forget about doing that. So a little bit of a break to the downside. Which is the bigger driver? So let's go to the trade tab here for ABBV. Here's the one that we're short. Here's the one that we're long, way out here into the 71-day time frame to go until expiration. And let's kind of scroll down through, and we can see that, all right, here's where we are, right? This is the one that we are long. And fairly wide bid-ask spread, almost dollar-wide bid-ask spread in this particular case. So if we were to close it out at this particular point, there's likely to be a little bit of slippage in that case. But the other thing to think about is if we change our layout to our long verticals layout, delta, theta, vega, probability in the money, okay? So this has a pretty big delta. It has a 78-cent delta, but it's also got a pretty big vega for that long option. It's got a 25-cent vega. Remember, vega is the sensitivity of our option premium to percent changes in implied volatility. So if implied volatility rises 1%, we're going to see theoretically a 25-cent increase in our option premium. But notice that if that happens because the price of the stock is going down, this relationship is changing a little bit. So right now we've got a greater sensitivity to directional price movement. If the price of the stock were to go down, right? If the price of the stock were to go down, okay? So this is down on the price of the stock, deeper in the money in terms of the calls. But think about that. That would put this 180 call closer to being out of the money. So what that does is, or closer to being the at the money position, what that does is that increases our vega number, theoretically, increases our vega sensitivity, and it decreases our delta sensitivity. So as the price of the stock goes down, which it's doing right now, we can see that it's down 1.9% today, already down about $3.74. Delta sensitivity decreases, vega sensitivity increases. So it becomes less directional and more binary when it comes to price movement, but it becomes more sensitive to that rise in implied volatility. So the thing about it is, price direction can probably move a little bit faster and still has about double the influence. So even if the at the money position, 60-cent delta, 30-cent vega, has about double the influence direction does of implied volatility. So we can't bank on the idea that if this goes down, implied volatility is going to buoy up an option that has very little intrinsic and all extrinsic. So we go back to this and we say, look, yeah, it's gone up a little bit, but maybe what we do is we close this long directional or bullish directional long vertical down at this point rather than rolling this short call because the price of the stock is moving in a counter trend direction. We expect this to move to the upside, right? This is a bullish expectation. So what we might do is look at closing this trade down. So what I'm going to do in this particular case is look for another opportunity to enter a long directional trade, but it just isn't right now. So what I'm going to do is I'm going to create a closing order, and we're going to look at selling this diagonal, okay, which means that we're going to buy back that short option, which is okay because we sold it for more than it's trading at now. And we're going to sell back the long option, which is okay because we're selling that back for more than we paid for it to begin with, right? Yeah, and we're losing against that P&L, right? So right-click, create this order to close this down for a 1660 credit. And we're going to go ahead and click on confirm and send, read through the order, and we're going to take a look at exiting this position. Again, make sure that we're aware of any transaction costs and any alerts there. We'll fire that order off and look at closing that trade down. Now, Mike asks a great question. Not Mike Fairborn, but Mike in the chat. He says, double diagonals, when are those potentially preferred? And are there any videos? And I'll take the first part of that question last. But when might those be preferred? A double diagonal is, if you think about it, essentially a neutral strategy. A long call diagonal expects the price of the stock to go up, right? A long put diagonal expects the price of the stock to go down. So you're looking for neutral directional movement, much like you would with an iron condor, for instance. The difference between a long diagonal and an iron condor is that a long diagonal has a separation in terms of expiration dates from the short leg to the long leg. You still expect the price of the stock is going to stay within that time frame or within that range, but instead of using short call verticals and short put verticals to create an iron condor, you're using a long call diagonal and a long put diagonal to bracket the range of price movement. So if those are created sensitive to not only directional price movement, but also implied volatility, then you're absolutely correct in the kind of rhetorical assumption, Mike, that a double diagonal scenario might be preferred over an iron condor in a rising implied volatility environment, a rising IV. Yeah, exactly. Right? You look for that scenario, Rich. Good comment. Banks on or expects rising implied volatility. So something to think about in terms of this context. So let me show you this where you might go to learn a little bit more about that. So I'm going to go to the YouTube, our YouTube channel, youtube.com/@Trader Talks webcasts. And you can come right down here to that. And that's what you're subscribing to when you click on that subscribe button. You can come right down here to this little search window, and you can type in double diagonal. And I've talked about it. We talked about it back in March. Brent talked about it in his advanced options webcast, double diagonals and straddle strangle swaps. I've talked about it. Oh, I talked about it in June. I talked about it in a little bit in a couple of weeks ago. So anyway, that's where you can get to some of that additional learning on double diagonals, right? Okay. So let's jump back over here to the Thinkorswim platform. And let's jump into our monitor tab once again. So we've got a position in there to close that. XSP is the other one that I wanted to look at really quickly. And we've got a long call expiring in 134 days, right? We've got a short call at the 563 strike that's expiring in 11 days. We're kind of at that point where we might look at managing this. The short call has gone from a price that we sold it for of $6.55. Now it's trading at about $1, theoretically, thereabout. So we gained about $5 in terms of this trade from that decrease in that option price in the 563 call. It's gotten closer to expiration. Prices maybe kind of pulled back a little bit from that point. That's an out of the money 563, the index is currently trading at 549. So that's a little bit out of the money. So it's lost a little bit of its value. So what we might do is use this as an opportunity to roll. Now, to Tada's question, which is how do you manage double diagonals? You manage a double diagonal the same way that you might manage an iron condor, which is the same way that you manage a short vertical, which is the same way that you manage a long vertical. You manage each one of those sides independent of the other in terms of directional price movement and option premium. You manage them independent. The expectation is the price of the stock stays within a range or does something directionally, right? So you manage the trade according to the way that you would manage any diagonal, which is what we're doing right here in terms of managing this diagonal. So let's click on the chart and let's take a look at XSP. We say, all right, look, XSP, we're short the 463, right? Or 563, excuse me, 563, which is right about here, right off that resistance level. And the price of the index has moved down a little bit, as has the S&P 500, right? But we're still long a deeper in the money option that's gained value through a rise in implied volatility, but also through that overall directional movement. So let's look at managing this. And so this is a good opportunity to kind of reinforce what I was referencing in terms of managing a vertical spread or managing a diagonal spread. Imagine this as if it were one side of a long double diagonal, right? And you expect the price of the stock to go up, and at the same time you expect the price of the stock to come down and kind of stay within the sideways range. So we're going to manage the call side. It's just the call side's on the bottom as opposed to the put side where we would be in a short vertical spread, for instance. So we're going to look at managing this call trade, the short call trade, and we're going to look at potentially rolling that out. We've got 11 days to go until expiration. We're going to look at rolling this one out. So what I'm going to do is I'm going to right click and I'm going to create a rolling order. Okay. And we might look at rolling out another week. That's going to put this out to the 16th of September. Actually, okay. So let me walk that back just a little bit, because this is where you got to pay attention, because remember, this is a cash settled index. So it's going to have, in general, more expirations. So we are we're short this 16 September. When I created that one expiration cycle roll, if it were an equity option, it would roll perhaps to the next week. This is an index option, and therefore I've got all of these other expiration cycles in the middle here. So what I've got to pay attention to is what cycle I'm rolling to, number one. And number two, remember that rolling isn't a magic wand. It doesn't guarantee liquidity in the target. So you've got to make sure that there is liquidity in the strike and expiration that you are rolling to. So let's go back to our rolling order right here. And we'll look at rolling out not to the 17 September expiration, which would be the next one following. But let's look at rolling this out, say, for instance, to the 24 September. So I'm going to roll that, which means I'm buying the 16 September, I'm selling the 24 September at the same strike, and I'm able to do it for $1.36 net credit. Now, this also gives us the opportunity, perhaps, to roll down strike price-wise a little bit. So we are at the 563. We could roll that down a little bit and pick up a little bit larger credit. So if we go back over here to the chart and we say, all right, look, we're short the 563. What if we were to roll down to this 560, 3 strikes down? And could we increase the net credit and pay down a little bit of the cost of that long option a little bit and still stay within the range in which this is likely to move? And if we're called out, meaning it's exercised, because remember, this is an index option, it can only be indexed, right? So John, the reason is overall the index is still bullish. Great question. John asked a great question. Short call still is profitable right now. Why roll it instead of sell it? Well, we're short that. So what we're going to do is we're going to buy it back, and then we're going to sell another one. So in fact, that's what we are doing, and we're buying back the one that we're short, selling another one, and just extending the duration of the trade, because we still have like 141 days to go until expiration on that long call, which is tracking that longer term trend of the index. So we're going to look at rolling this down just a little bit down to the 560 strike. So we'll roll this down to the 560 strike, and we'll see what our credit goes to. It goes to about $2.40, right? And all we did is we moved our strike. Let me bring this down. We moved our strike from here at the 563 to the 560, right? From here to here. And if the price of the index rises through that, okay, that's fine, right? There's nothing wrong with that. That's fine. That supports our premise. Now, what we may have to do is buy back that option, and it might be a little more expensive, but we're bringing a little more credit here to accomplish this roll. So I'm going to go ahead and click on confirm and send, and we'll accomplish this roll. And again, remember that a rolling order, not a magic wand. We need to make sure that we're aware of any transaction costs. It doesn't eliminate transaction costs, and make sure that we're liquid in that target. So we're rolling to the expiration, the 24 September expiration, rolling down to the 560 strike. Click on send, and we'll see if we can accomplish that roll. And that might just sit there. We might have to bump it a little bit. We'll go to the working orders, and we'll cancel and replace. We'll kind of open that up a little bit, open that lock up, and there it went. It filled for us at 239. So we didn't even have to do that. We just needed to be a little bit more patient, which is sometimes a challenge, isn't it? Especially when trading vertical spreads. That is sometimes a challenge. All right, let's take a look at a couple of other examples of stocks that, despite the fact that the market as a whole has been moving down, have actually been moving to the upside. UAL is one of those. And I was looking at this the other day in terms of the context of a bear flag, but implied volatility is relatively low. We've got this earnings announcement over the horizon on the 15th, or on the 15th of October, and implied volatility is generally lower and rising. So that's going to we're going to look for that benefit of that rise in implied volatility. So price is definitely moving to the upside here, despite the fact that we've had this kind of intermediate term downtrend. So looking at trading this kind of intermediate uptrend counter to that intermediate term downtrend, looking for bullish movement here. So we're going to look at a long call vertical spread. Now, there are other ways to think about this. The problem is, because somebody might ask the question at this point, well, if you expect that this is going to move higher, why not sell a short put vertical? Well, the problem is if implied volatility rises, as it has been doing, that rise in implied volatility hurts the short put vertical. But a rise in implied volatility and choosing a long call vertical takes advantage of the possibility for more directional upward movement, number one, and number two, benefits from a rise in implied volatility. So if implied volatility overall generally starts to move higher, that works in our favor. The problem is, or the challenge is in this particular case, is if the market starts to move to the downside and implied volatility starts to rise, there is a possibility that the price of the stock could go down too, which would raise implied volatility, but it's going to work against us directionally from that delta sensitivity. So it's one of those scenarios where, it's a mixed bag, but it's a defined risk trade. So we know what our risk is theoretically getting into the position. So we're going to look at going to the trade tab here, but I want to identify where I've got a level of support here, maybe right around the 44 mark or so. And my expectation is continued upward movement. Now we've got some resistance overhead at about 48. possibility of that upside move. So let's go ahead and let's take a look at this in the trade tab. Close down our position statement here. And so what we're going to do is we're going to look out. In this particular case, I happen to have one already that's rolling off on United Airlines. But let's look out here, say, for instance, 11 October. That's going to be out to that earnings announcement, which is going to come in on the 15th of October. Maybe we roll out to this one here. We look at selecting out to the 18 October expiration. Now, what that means is implied volatility is going to be a little bit higher. We're going to be selling more implied volatility, but we're also going to be buying a little bit more implied volatility. Bid-ask spreads are about 10 cents wide. So we're going to look for an option that is slightly in the money. And we're going to do this so that we can make this a little bit more volatility sensitive, right, to a rise in implied volatility. So what we may think about then doing is buying a little bit deeper in the money, maybe buying down here to that. I'm going to buy down to the 40 strike, right? I've got 82 cents of directional delta. So directionally sensitive option. It's going to be a little bit more expensive, not hugely so. But it's got a 4-cent Vega number here, and I'm going to click on that. I'm going to use my control key. We're going to hold that down. We're going to look at buying that 18 October 40 strike call deeper in the money. Now, that might be deeper in the money than some traders generally consider trading. Then we're going to look, because we said we had that resistance level up here, maybe right around 47. We're going to go back to that trade tab, and we're going to look at maybe selling the 47 strike if our expectation is the price of the stock is going to make that move. Now, the other thing we could do is we could go to the 46 strike, which is the at the money strike, a little bit attenuated from that resistance level, and assume that the price of the stock is going to make that move up through 46 on its way to 47. And so we're selling that for about 40 or 50 cents more. So look at selling the 46 call. So now what we've created is a 6-point wide vertical spread for $3.90 debit. So paying a little bit more than half of the width of the spread. So if we click on confirm and send, we can see that our max theoretical gain in the trade is $2.10, but our max theoretical loss is $3.90, what we're paying for it. The thing about it is we're buying an option that's deep in the money, that's likely to stay in the money unless the price of the stock reverses. It's got a deep delta, meaning it's got a, if we think about delta, remember, is the sensitivity of the option premium to changes directionally in the price of the underlying stock, but it's also sometimes used as a proxy or an approximation of the probability of that option being in the money at expiration. So we might look at that and say, look, here's the one that we're going long, the 40, that's got about an 80% probability. Or if we were to calculate it using the probability of in the money calculation, which is theoretical in nature as well, it's got about a 77 to 80% probability of being in the money at expiration. Okay. So that's exactly what we want to have happen. We want that one to be in the money at expiration. And in fact, we want the short leg to be in the money at expiration as well, or before expiration, because that's how this gets the theoretical maximum gain. So we're going to look at putting that trade on. And if I right click on that trade and we throw it over on the Analyze tab, all right, there's the characteristic shape of a long vertical spread, right? Characteristic shape of a long call vertical spread, expecting the price of the stock to move to the upside. And our max theoretical profit range kind of falls right within the probability range. If we go out to our expiration date in this particular case was, what did we say? Let's bring that up here a little bit. 18 October. So let's take that range out to the 18th of October. We're kind of right dead smack in the middle of that probability range, right? Based on implied volatility, based on one standard deviation. Where is that stock likely to be? Well, somewhere between here and here. And we're right smack in the middle for our profitability range. In fact, we cover kind of the majority of this range over here with the area in which we make theoretical maximum gain. If we go over here to our break-even point, well, then we see that, we're capturing more of that probable range with the range in which we make some money in the trade. So theoretically, this is all theoretical. Remember, all of this Analyze tab stuff is theoretical in nature. So what we're going to do is we're going to click on confirm and send, read through that order, make sure that we're aware of any alerts or anything that we need to pay attention to, and we're going to go ahead and fire that order off and look for that trade to work in. Yeah, we could carry it through earnings. We could exit that prior. We could look at rolling it. But theoretically, what's going to happen after the earnings announcement, Rich, is that typically, we go back to that chart, notice what happens to implied volatility typically after or just before the earnings announcement. Implied volatility tends to collapse or crush after that earnings announcement, right? And so that works against us in a trade that is sensitive to both implied volatility and directional movement. Now, let's see if we can do that. That one had about a 1 penny sensitivity. We go back to that trade tab and we look at these two. So actually 2 cents. We sold the 46 and we bought the 40. So that had about a 2 cent sensitivity to implied volatility, right? That was working in our favor. But yeah, Rich asked the question, what about gamma? Gamma typically isn't going to be a factor here until we get into those last few days prior to expiration. So something to pay attention to, and then it becomes a significant move. But that assumes that you're in the at-the-money position. So if we've seen a directional move, and this is deep in the money, it doesn't become as big a factor. If we're sitting at the at-the-money position, it certainly can't be a factor. So let's take a look at the chart here again really quickly. I want to put together one more quick discussion here. This is Delta. And Delta kind of sitting at this little bit of a breakout. And same thing, same forces at work here. Implied volatility is backed off a little bit. That maybe gives us an opportunity here to get in with implied volatility being a little bit lower, a less expensive long leg, but maybe retaining a little bit of that implied volatility in the at-the-money position. So I'm going to go to the trade tab once again for Delta, and I'm going to look out over the horizon here in this particular case. We know that Delta's got an earnings announcement coming up on 10/10. So we're kind of in the same boat, same scenario here. So what we might do is look at this 11 October expiration, and we're going to go once again deeper in the money. Maybe we go down here to the 38 strike, 83-cent delta. We go a little bit deeper in the money to buy the long leg, and then we go to the at the money, currently trading at 42.64. Technically, the at the money is going to be the 43 mathematically. Greatest amount of extrinsic is probably going to be at the 42 strike. So we're going to look at selling the 42 strike, even though it's kind of right at the money position, right? It's going to give us roughly a neutral theta and a little bit more sensitive to changes in implied volatility side. It gives us some sensitivity to rising implied volatility in this particular case on the long leg. So we're going to sell the 42. Now we've got a 4-point wide vertical spread, and we're paying for it a little over $2. So a little bit more than half. Again, 131 versus 269 in this particular case. Theoretical maximum gain occurs if at expiration, this is out at that 42 call, and these expire in the money or end up in the money at expiration, and then are assigned and exercised to accomplish that trade, and that's where we would receive that theoretical maximum gain. We may look at closing these down prior to, but we're going to go ahead and click on read through the order, make sure that we're aware of it. Any alerts that exist here, we'll click on send, and we'll fire that order off and watch that trade as well. So a couple of directional trades that are sensitive to changes in implied volatility. We managed a number of the trades that were already in here in this particular case, managed a long vertical, managed a couple of long, in this case, a long call diagonal. And it looks like this FedEx one is something that we need to pay attention to here. We might look at closing that out here at this point. The long leg is in the money, short leg out of the money, and we've lost a little bit. We're a day to go until expiration. So what I'm going to look at doing in this vertical is creating a closing order, managing this positively prior to expiration as opposed to letting it go into expiration where there is some uncertainty as to what's going to happen. Looking at bringing in that $1.60 to offset what we paid for it to begin with. We'll read through the order, make sure that we're aware of any transaction costs and alerts, and click on send, and we'll fire that order off and eliminate that. Yeah, that Delta one out that at that level has some limited open interest. So Jerry, something we got to pay attention to. Guys, great stuff today. Once again, check out the Trader Talks webcast if you want to learn a little bit more. Fill out that feedback survey. Follow Mike and myself on X, formerly known as Twitter, at Ben Watson CS, at Michael Fairborn CS. And again, thanks for joining me. Hope to see you at some of our live events. Have a great day, everybody. Take care. Bye-bye.